A week ago, we took time away from our point and figure workshop to look at the current condition of the markets, the indexes. Some very important things were taking place in those indexes, and we wanted to address them at the time. I hope that you all got value from that and also saw that there was some looming clouds on the horizon that we were able to see at the time. Let's bring those conditions up to the current situation because a lot's happened in the last week. And then we're going to look at some point and figure work. Hopefully, this will circle back into the discussion that we're having right now regarding the markets. Bullish percent of the NASDAQ 100 here. This is a daily chart. We have a reaccumulation structure here from September into November, and then a really nice uptrend. This uptrend had a series of higher peaks that were confirming the upward trend. They were lower than this peak, but this was really a very positive sign because this was like a breadth thrust. It went above this high here to a new high and suggested that there was great internal strength in the market, got up to 85%. When it came back, it made a higher low, higher low, and then also a higher low in the NASDAQ 100. They were confirmatory. We love that, confirming upward trend. Another confirmation at this low. Well, this works in reverse. So we have divergent characteristics that showed up. We talked about them last week. Notice this peak right here and where it came. This peak came right about here. And then the market, the bullish percent index really tumbled with a rather mundane reaction in the NASDAQ 100. That was evidence of internal deterioration in the NASDAQ. And we could see in these dominant leading growth names that there was some weakness that had occurred. A rally followed, and this peak right here is a divergence because we had a higher high. Momentum again asserted itself. It's a very powerful tool in trading. The momentum took the index up to a new high, but there were fewer stocks in this breadth indicator that were participating in the upward move. Divergence, and that divergence was a warning to us. We talked about this last week. Now, this is a subtlety, but I want to really point this out. Look, this indicator's down to 35% here. Well, we had a pause in the NASDAQ 100 a couple of days ago, and this pause was involved in a very weak decline to this 35% level, no apparent bounce yet. And so now we're getting into a relatively oversold condition. It may ultimately prove to be a good low out there, but we have what could be distributional conditions. We have preliminary supply, we have some kind of a climactic surge, divergent characteristics, and now we have weakness, and the weakness is a sign of weakness in this indicator. This is the bullish percent on the S&P 500. We looked at this last week, as I recall. You can see here similar characteristics. We have upward trend higher highs. We have lower highs occurring in the bullish percent of the S&P 500 as this is all going on. This is an advanced warning. Also in this correction, as was the case in the NASDAQ 100, we had a substantially weak reaction here down to almost the 50% level in the bullish percent. Now, there is a positive in here, and that is that so far these are all higher lows, and we have a higher low here so far. Now, that may ultimately result in further weakness and take the bullish percent down for the S&P to new lows, or take it below these lows, possibly these lows. We're going to watch that very closely. So divergence is there. This chart we looked at, this is a 4-hour NASDAQ composite chart. And here we have a trend line drawn here on these 2 points, parallel overbought line. Look how beautiful this is. It throws over here and here. We showed this last week and we said, hey, we're overbought here. The other thing that we had is look what was happening. Here's the peak. Now, these are very subtle things you should look for. Here's the peak right here in this indicator. And let's erase this and clean this up. And you can see that now this is the new, the NASDAQ Composite Advanced Decline. Different kind of a breadth indicator, works in a similar way. Notice that this line is weakening throughout this final little push up into a new high. And the breadth indicator, 5-day moving average or 5 period, this is a 5 period of a 4-hour data set, is falling and falling and falling down to an oversold reading. And look at what happens as the market rallies up here. And we warned of this because we want to look at how the market rallies off good support. We had support at these points, at this point, and along here. Well, we did get a rally. It was a rally of poor quality, and so far it hasn't lasted very long. Look at the reaction here as the NASDAQ composite is reversing back down, not to a new low yet, but we have very poor breadth advance that occurred. And notice how, as this rally is going up, this line is dropping here. A very subtle clue that there was trouble, and sure enough, the market reversed substantially. Now, this is the equity put call ratio. This is such an interesting indicator, and people actually, I think, are a little tired of me looking at it. Back in 2020, January, February, this was near record readings in the equity call buying readings, volume and ratio. And then from June on, these were records that exceeded last year. And so very high volume in the equity put call. Well, very tiny little clue on that 425 point advance in the Dow yesterday is that this line was trying to go up on the equity put call, and then on that big rally, which did not confirm in the NASDAQ and NASDAQ 100, NASDAQ Comp, and the S&P, is the call buying went almost to a record. It's just above this reading from mid-January. And so this shows that as soon as the market started to go up again, the bullish behavior among speculators took off right away. That is not a good sign. It's better to see the market climbing the wall of worry. This is not an example of climbing the wall of worry. This is the S&P 500. Two small trading counts in the S&P 500 here. You can see this is a 30-minute chart, 10-point scaling. I like to use 10-point scaling when possible for the S&P. Easier to count, but also I do check it against ATR scaling to make sure I'm in the ballpark of the scaling that the ATR would calculate. I took this count here, and that count went down to 3770 from the high, slightly lower from the count line. This count I took over across to here. This count counts down to 3690. And so there are two counts, and this makes a lot of sense because look where it puts us into the range of the support area. Now, we go down to this area, we go through it, and then let's say we rally up again. Well, now we have the conditions for a much larger distribution. That's the thing we want to watch for. So let's hope that those positive divergent characteristics that are inside of the breadth of the S&P, which we're looking at the S&P to the New York Stock Exchange breadth actually. Let's see if that can continue to work and put a prop under the market. So far, the S&P doesn't look like it's in too much trouble yet, but time will tell. Now, here's the New York advanced decline to the 30-minute S&P over here. This is the same data that we just looked at. We counted this area across here. We counted the larger area across. I just want to show you this 5-period New York advanced to decline data set, and you can see that now it's starting to really fall on a 30-minute basis. So it's becoming significantly oversold. Well, it's possible that oversold may set up a condition for a really good rally. We may be able to go, I think with an oversold like this, we could have more weakness come in before we're done making some kind of an important trading low. But here is important support across here and across here. And so let's see if that support can work for us. Here's the S&P with a trend channel that goes back to November. It's a beautiful trend channel drawn on these early points along here with a parallel overbought line here. Well, this is what the NASDAQ composite did. And the NASDAQ composite became overbought here. We talked about divergences occurring. It's exactly what happened. We had a high, good kind of breadth high here. This is the New York advanced decline. And then this was pretty high, but slightly diverging, not anything really worrisome yet, but look here. This high and this high are really, really on weakening breadth data. This rally here came along. Now we've broken the channel. We've rallied back into the channel and we had a breadth improvement, but to a lower high. So not yet. Now here, potentially we could be getting some good divergent characteristics. We have to hope for that. 2-hour data is what we're looking at, but we're back below the trend channel. Here is the area that we counted on the point and figure, and it took us down to a 3690 count, which is right about here. And remember, this is our support area. So it sort of gives us a roadmap. All right, what do we have? Triple Qs. I really have been, this chart I've been using, I think I showed it once before. Look at the central tendency of this demand line trend channel that we have, and look at the periods of weakness that have broken the upward channel, but then it turns around and gets back in gear again and goes up. But notice this upward thrust just rides along the demand line. And when it finally gave up the ghost, it gave up the ghost and started to really fall. So this is quite a bit of weakness. We're getting into the area of good support. And so let's see whether or not that support can hold. But it's starting to look like we have very much of a trend change. Let's think in terms of a range-bound condition, climax, automatic reaction, range-bound condition, as we had from September to November. Finally, we should finish up here. This is the NASDAQ. This is 30-minute data. Love to look at this chart. I'm just showing you the charts I use to look at the internal characteristics of the market. So I was going to talk about something way different today, but I thought this was really useful for us to talk about. And we did talk about this last week before the market broke. And I think it was very timely for us to do that. So that's really good. Wyckoff treated us well last week. So let's turn around and see whether or not it can guide us further along here. Here's our support area. Notice the lower low here. So there's momentum. This breadth in the bullish percent is really low now. I believe this means that we're going to get a lower low in price, maybe go slightly below these support areas and spring them. That's the bullish case. But now this is starting to look an awful lot like distribution on a larger scale. So we'll just keep up on this in the weeks ahead. So stay tuned. Let's turn our attention to how we can use point and figure as a very powerful and effective research tool. This is a ratio chart, relative strength chart, comparing the iShares US Growth ETF to the iShares US Value ETF. And this ratio is plotted here as a vertical chart, and you can see classic distributional structure: buying climax, automatic reaction, upthrusting action here, series of secondary tests, last point of supply, and then a markdown that's occurred out of the distribution area below support, may get back up in there again. We'll watch it closely. But what I'd like to do is emphasize how we can use the point and figure of this data set and be able to do some really terrific research with that with point and figure. Now, this was submitted by one of our students at the Wyckoff Market Discussion Group that meets on Wednesdays, and we're going to have an upcoming episode that you can attend here at the end of the quarter, somewhere around there. So just watch for that. I'll try to announce it also. But here you can see beautiful accumulation area. Now we're looking at much more data here on the point and figure, but this goes from around 2011 back to 2001. Classic accumulation area that you can see on the point and figure. 3-box reversal, 0.01 scaling. But notice here how our student has been able to develop counts off of this relative strength relationship, and then has flagged objectives upward from that. And this is the distribution area that we just looked at on the vertical chart. But notice how this flagged right into the area of this immense 10-year uptrend of growth outperforming, and gave us a really nice count on the relative strength and into a climactic surge here at the end, which stopped the advance and now potentially is reversing it. So this is really just a great chart, and I'd like to thank our student, who wishes to remain anonymous, for allowing me to show this to you. So great example of how to use research on these different data sets. Here's a more traditional example of how to use point and figure as a research tool. And this was inspired really by Dr. Pruden on some great studies that he had done of accumulation areas that were at the conclusion of bear markets that set up the conditions for an important uptrend in prices over a period of time. And so here's just a great way that point and figure just can really be an exceptional device or tool. Here is the accumulation area in the triple Qs that we took 3 counts, ever widening larger counts through this area. You can see this nice distribution up here also, and which did a really good job. But these counts gave us really objective points along the way where the market stopped and then rebuilt new reaccumulations for higher prices, and those have been flagged here. So in this case, we have a largest count, which this goes back to the study that we just looked at a minute ago, which was the ratio between growth and value in very large area. Well, look at this count. Goes from around late 2011 back to 2001, literally a 10-year point and figure accumulation area count. And notice if we take the largest count across, each one of these has been very useful in terms of flagging objectives. But here is the largest count that we've taken so far, and it's taken us up to this 290 to 325 area. And we have just literally thrown over the top of that very recently up to this 338.19 area, which is the recent high. But this, and then also notice these two counts. Well, is it possible here, just to make the case for the continuation of the bull run, that this count here could be taken also? So, but we want to respect these counts because they do tend to stop the advance and cause another reaccumulation area to occur. So let's keep that in mind, and we'll come back to this chart in the future. Okay, so if you'd like to know more, come visit us at the Wyckoff Market Discussion and become part of our discussion group where Ramon and I talk about the markets every week. We talked about the conditions of this market. As a matter of fact, yesterday, it's every Wednesday afternoon. And so here you can go and check out a prior recording that we did. And also we're going to have a free episode right around the end of the quarter, late March. And so keep an eye out for that. You can go in and just sign up for notifications of these things. This is the chart that I did, which is the my value to growth ratio. I did it in reverse. So I'm showing Russell 2000 as a value, small cap value, compared to the triple Qs, which is big cap growth, which has been so dominant for so long. Look at this beautiful base. Now, I've shown this here in power charting before. Actually, I started to profile this back in this area, and you can see that you had a spring, a beautiful test of the spring, a last point of support, really good sign of strength, and the backup. And look at this. What is remarkable to me is that since September here, the Russell 2000 has been dominant and leading, higher highs and higher lows compared to the triple Qs, large cap NASDAQ growth stocks, since September, and really has outperformed dramatically. There's some accumulation schematics. We'll talk about those in more detail later. I just want to show you this chart here. I can tell I'm going to run out of time again, but I'll be back next week and we'll do some more of this because I have some more cool charts for you. I wanted to show you, this is the 10-year Treasury yield back in 1986, 87, 88. And you can see here that there's a base building in yield. So this is low yields, base is being built, and then you have an upward trend of US Treasury 10-year yields that have taken place. I put a 13-week rate of change. This is weekly data underneath so that you could see the tremendous bulge or surge in interest rates in the upward trend of rates, and how this actually, after, look at this long decline here. I mean, a very impressive decline in interest rates from 84 to 87. Now, here is an incredible bull market run from 84 to 87, which was dominated by large cap value and some small cap value. So something that seems to be starting to emerge now when we look at the value ETFs and we look at the Russell 2000, etc. But notice this big bulge here into a climax in the S&P 500, and then a lower high. This was August, lower high in October, into a surge of higher interest rates, and that set up a very important, very stiff reaction. I'm not predicting that here, but I want to make the point that fast and high rising interest rates is a detriment to stock prices and can be disruptive to stock prices. And so what do we have going on today? So here is today, we can see similarities. Here's the interest rate. Since 2019, interest rates have been falling dramatically. Here is our base. Here's our low and our base. And with this backdrop of low interest rates here, you can see that, and here this is 0.6, this is under 1%. So interest rates, now keep in mind, this is the one thing that's different. These interest rates are upwards of 8, 9, 10%. So they've gone from under 7% up to 10%. So much higher interest rates, but stocks had much better value, higher yields, much lower PEs than they do now. So that's the offset here. Very low yields, much more expensive stock prices. So here we can see that after yields make a base here, we have this important rise that's taken place since the middle of 2020. This coincides pretty much with the beginning of the rise or the rally in the small cap value as measured by the Russell 2000 and by the value index that Carl had in his chart. And so we can see that growth started to lose some of its dominance as rates were starting to complete in a very important base and go into a very important uptrend. Well, look what's happening here. We're having an acceleration of rates upward. Look at the rate of change here. The rate of change is very high. Well, the rate of change got up to just over the 20 level back in 1987, 88. But here it's upwards of 75%. So the rate of advance of interest rates is accelerating and jumping at a much more dramatic rate, but from a much lower level of interest rates than back then. And you can see that we have quite the dramatic upward trend in the S&P 500. Here are the two periods here for comparison. You can see, and I'll leave this to you to compare. Here's the base in back in the 1980s. Here's the base in interest rates currently or recently. Here is the upward trend of yields, and here was the upward trend, and you can compare the 13-week rate of change one to the other. And so here was this big uptrend. Ultimately, the uptrend was stopped, I think, by high interest rates. Here, the question is, will these higher interest rates that we're seeing now stop the upward advance of the stock market? So this is the big question. We are seeing some issues with this, and we are going to watch it closely week to week, so stay tuned in. So I'm going to close with this. This is Bitcoin Point Figure. I showed you this chart last week, and here's the base, big beautiful base, counted from a count line, a low of 3,500 up to 10,000. The count line's at 10,000, counts to 50,000 to 56,500. And we have gone up to 58,348. That's the highest I've seen it with the data I have available to me. It was pointed out yesterday in the Wyckoff market discussions that we might be able to stretch this count out to here. And so we will look and see whether or not the count can grow larger. But here, as I showed you last week, this count also confirms this count here, 54 to 63, and we're right smack dab in the middle. And with that, I'll say goodbye and see you next week, and we'll look at some more of these really cool charts. Take care.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.